evening and welcome to the Money Show. I'm Kavita Thapliyal and this is the place where money stops being confusing and starts working for you, because let's face it, every decision we make, from the coffee buy in the morning to the home we dream of owning, from planning your next holiday to searching or securing your children's future, one thing is common, that is money. Yet despite the role it plays in every chapter of our lives, very few of us were ever taught how to manage it, grow it or make smarter financial decisions. And that's where we come in. Whether you are just starting your financial journey, building wealth, investing for the future, planning your retirement, or simply trying to make your salary stretch a little further, this is your show. In this show, we also answer your portfolio queries. So just in case you're wondering, you need any help on your investments or your financial goals, send across your questions on the WhatsApp number that's flashing on the screen. And we also have an email ID where you can reach out and send across your question. The WhatsApp number is 865-797-4571. The email ID is themoneyshow@etnow.tv. All right, but today we have our senior citizen special. That's right. This is a very special edition dedicated to our respected senior citizens. After decades of hard work, you've earned more than just retirement. You've earned financial peace of mind. Your retirement savings are more than just money. They are the reward for a lifetime of dedication and hard work. So in today's show, we'll help you invest wisely, avoid common financial mistakes, and make every rupee count. So let's begin this session today. All you have to do is just stay with us. We will simplify personal finance for your golden years. And to help us do that, we are joined by Srikant Bhagwat. Srikant, hi, good evening and welcome to the show. A very important aspect of your entire financial life or your investment journey, retirement, which is supposed to be your very first goal. You know, it's said that with your first salary, you should start investing for nothing but for your retirement. But this is a senior citizen special for our respected seniors. I just want to start with a very basic question. Many retirees focus on accumulating wealth but overlook how it's invested after retirement. So if we have to just start the conversation by putting the spotlight on post-retirement asset allocation, how should that be and why is it critical in the first place?
Thank you so much for having me on this show, Kavita. Always a pleasure to be on the show, Money Show with you. And rightly said, this is a senior citizen special, and they've finished all their accumulation goals. And as they come in with the money, they need to figure out how to invest it. And the most important decision one has to take is the asset allocation decision. So for all the money that they want to use, or you may call it the corpus or nest egg that they want to use for retirement income, so that needs some work, okay? Because you want the income coming out of this corpus to last you for the next 30, 40 years. With today's sciences and longevity, one can easily assume a 95 years kind of longevity. It sounds stretched, but well, I think it's going to be happening. There are very, very good chances that it's going to be happening, that you may even go beyond 95, Kavita. All right. So how do you make it last? You can make it last by ensuring there's enough growth component to your portfolio. Just because you finished earning and you're retired doesn't mean that all your money goes into debt. Of course, if you have lots of corpus and you don't want to undertake any volatility, then you could go into all debt. But then your calculations have to be very clear that the money coming out of the corpus is being compensated for inflation year on year on year. Okay, you see, inflation keeps compounding. It's not simple interest, it is compounding. And your portfolio also should be compounding at least that rate and beyond to be able to serve you the capital. So some amount of equity, some amount of debt. More debt, less equity is the kind of formula one would look for. And we find that maybe about 25 to 30% of equity is the minimum that you should be dosing your corpus with.
Right. So exactly. Now that this is the exposure or the ratio that one needs to maintain, because Srikant, you're also talking about balancing growth and income. Okay. How should retirees balance the need to beat inflation while ensuring a steady income? Because that is a very crucial aspect.
Okay. Yeah. So let's look at some numbers. Okay,
Sure.
as illustrative. So suppose you were able to get some 6 to 7% out of your debt. Okay. And that is 70% of your portfolio. So you can assume about 4% is a contribution from your debt component. And if you assume about 13% is your equity rate of return over the long term, okay, then you can assume another about 4 and odd percent contribution coming from equity. So together, a 4% from debt and a 4% from equity, you would be getting about 8 and odd percent over the long term from your portfolio. So if you think that 6% is your inflation, you are getting about 2 and odd percent as real rate of return. Okay. So that should be okay if you're as long as you're earning more than inflation.
All right, but then is it possible to generate regular income without compromising the long-term growth of the retirement corpus that you have accumulated?
Yeah. So that's a challenge. By itself, like a bank deposit, you won't be getting income out of it. Okay. Because you are, I'm assuming, largely going in through mutual funds. If I'll come to mutual funds, in case you're buying bonds, then they have a regular payout, either a quarterly interest payout or a half yearly or annual interest payout. But equity doesn't pay out. If an equity fund, unless you're in the dividend option, it doesn't pay out. And dividends are not tax efficient today. So if you're putting all of it into growth options, what you have to institute is a systematic withdrawal plan. So once you have retired, what you want to really mimic is the salary coming into your account. We are used to the salary hitting our account the first of every month. How do we manage with the retirement corpus? So the SWP is like a standing instruction given to your mutual funds to say that X amount of money should be withdrawn every month and come into your account. You can choose the date. Let it be the first. Okay. So the good part about it is you can have a fixed amount coming in, and then every year you can keep increasing it for inflation. Okay. And the third part about it is it's very tax efficient, Kavita. Okay. Because when you're withdrawing units from the mutual fund, a part of it is principal and a part of it is gain. And only the gain part of it gets taxed at the long-term capital gains rate. So overall, if you were to make a table and measure it on an Excel, you will find that of your cash flow, maybe 4 or 5% of it is going towards taxes, and the rest of the cash flow is your net cash flow for income, which is what makes it very interesting and efficient.
Srikant, let's focus on the liquidity aspect also, because that is a very crucial part of your retirement planning. Now, how much of a retiree's corpus should ideally remain liquid, or maybe for unexpected expenses? How much should you have that cash parked somewhere where you can easily access it?
Ideally, all of it should be liquid enough that you can take it out at a short notice. So generally, in a mutual fund, you can get your money out in 3 working days' time. So that is sufficiently liquid. And you keep some amount of money as an emergency cash, which you can draw out in a 24-hour notice. Either it can be in a mutual fund or it can be in your bank deposit. So you can access it through an ATM. So a bank deposit that way makes sense. And that is something very subjective. How much do you want to keep as an emergency cash? Okay. So what do you want to cover generally? Medical emergencies, travel emergencies is what you want to cover. So maybe 5 lakhs to 10 lakhs if you keep as an emergency is good enough in a bank deposit or a liquid fund. That also you can divide it. Some in a liquid fund, some in a bank deposit if you want to really optimize on the return that you're getting, Kavita.
All right, but then why is liquidity such an important consideration in retirement planning? Because unexpected expenses can come at any point of time in your life. But why after retirement the thrust should be given a little bit more?
Yeah. So one is the emergency expenses part of it. Okay.
Right.
The second part of it is you want to rebalance your portfolio. Suppose it is locked up in a long-term risk-bearing asset. You do not have the flexibility to rebalance your portfolio. So which is why we should keep it as simple as possible, the portfolio construction, with the simplest of equity funds, with the simplest of debt funds. Okay. So that suppose you're going in for an annual rebalancing, you do not have a challenge as to saying, oh, this is a sector fund I cannot rebalance now. This is a momentum fund I cannot rebalance now. Keep it simple and liquid. So you can switch between equity and debt and equity, as in when the asset allocation varies too much. Typically, we say, let's rebalance once a year.
All right. Portfolio rebalancing and keeping it simple. Should retirement portfolios be simple rather than overly diversified? And if not diversified, too much of concentration will also be bad. So, how much of a concentration is bad, and how much of a diversification is bad for retirees?
Okay. So for anybody, retiree or not, excessive diversification kills your return. You'll go below average when you have excessive diversification. And in the case of a retiree, don't have concentration, because one investment not going through well can impact your entire corpus. And you don't have the margin of having another salary income coming in so you can top up the bucket. No. So ideally, just be sufficiently diversified. What do I mean by that? Don't take thematic calls. Don't take sector funds. Okay, number one. Number two, ensure that you don't have too much in any one single scheme. Don't have too much in one single AMC. Okay, so maybe you can have a limit of, say, anywhere 10 to 15% in a scheme and not more. So it does mean that you'll have more schemes to manage. Okay, but then it is safer than having a concentrated investment. So these guidelines one can use for AMC and for scheme, not to be concentrated. You may also come across focused funds in equity. So focused funds also bear a higher concentration risk. This is also something you can avoid, and be with regular large cap, flexi cap, large and mid schemes in a retirement thing. I would even avoid small and mid cap funds. Get your small and mid cap exposure through the flexi cap or large and mid funds. You don't need it in your retirement corpus.
But what about exposure to other asset classes like gold?
Yeah. So gold as a diversifier, anywhere up to 10%. We have seen now over the last few years that it does good. But I don't think it is critical to have in a retirement portfolio. That amount of money is not going to generate income for you. And whether it grows or not is a probability, unlike debt. So if you had to have, say, 10% gold, you'll have to sacrifice something else. You wouldn't want to sacrifice equity, because the equity rate of return you will not get out of gold with greater predictability. Then you have to sacrifice debt to put into gold. Okay, in which case the income part is reduced. So if you had to, you would have to sacrifice debt and put a little of money into gold there.
All right.
So other
Sure.
asset classes would be this or real estate.
Okay, so real estate, you would want to invest through REITs, mutual funds, or you're talking about having like physical real estate, which a lot of them might also have already.
Exactly.
Yeah.
Yeah. So physical real estate is good if you
Okay.
can afford to buy a good piece of commercial property. I don't think residential properties give you the kind of return that you would be wanting. Uh, if you cannot afford to buy a commercial real estate by yourself, you can get some exposure through the real estate investment trusts, which are REITs. Okay. So REITs typically have a diversified portfolio of real estate, generally commercial, and whatever income they get out of it is distributed as quarterly dividends. So it's a good income stream to have, either a REIT or even an InvIT. Okay. But before you get into a REIT and InvIT, do calculate what is the yield you're getting out of it. If the yield does not look attractive, I would suggest wait till you get a good, attractive yield. Today, REITs are all in the lower single digit in terms of yields. So one would think twice before wanting such a low yield.
All right. Let's talk about SWP. Now, how do actually SWP, if we want to compare it with the traditional strategy of having a regular income, how would it fare as compared to that? Because SWP, no doubt, it's really popular, but as compared to your traditional fixed income options in terms of tax efficiencies and cash flow, or you think that, having an SWP over your equity investment and having like a fixed deposit and having that as your regular income, a combined strategy would work for you?
Yeah. So compared to fixed income, this is more tax efficient,
Okay.
an SWP
Right.
option, because only a portion of your cash flow is counted as gains, and only that part of is taxed as long-term capital gains. So till your portfolio reaches a long-term capital gains exemption, kind of long-term capital gains tax rate, you should keep money into more tax efficient options like arbitrage funds. So the first couple of years of withdrawals can come from arbitrage funds, and subsequently it can come from your hybrid funds, say a balanced advantage fund or a debt fund. But ideally, maybe a hybrid fund like a balanced advantage fund comes in very handy at these times. Okay? Because tax efficiency is there, and you do not have to do much of rebalancing there. It forms a bridge between your debt and your long-term equity in that sense. So you'll have arbitrage funds, debt funds, balanced advantage funds, and equity funds. And this is how you can really build your retirement corpus. Within this, if you want to have some REITs or InvITs or bonds, you can work it into your asset allocation.
One last question, Srikant, before we take a break and slip into our viewer queries. I wanted to understand if someone is really sitting on lump sum money right now, how should one invest that? What kind of parameters and what kind of consideration from your end the investor needs to factor in before putting it across asset classes?
Yeah, good question. Because generally, once you retire, you get a lot of retirement benefits. Either your EPF is available, or your gratuity money is available, or some other assets become free. So when you have a lump sum and then you need to invest it, you need to ask a few questions. One, what is the asset allocation that you already have? And what is the asset allocation that you need? I would say that if you have more than 30% equity, cut it down to 30 or lesser. Okay. So, and the rest of it can be allocated. You suppose you're deficient in equity and you need to start buying some equity now. So you have a lump sum in hand. I would not suggest you go and thada karke put everything into the equity market, because any risk bearing asset, you should go in slowly. Because now your risk bearing capability is lesser once you have retired, because you do not have the ability to top up or bear losses. So you have to do it like an STP, a drawn out STP. Take your time about investing into the equity market. You can do 6-month or 12-month STP. So if you have an advisor with you, so based on the market valuation, he can tell you whether to go in quick or take a little more time in investing it. Okay, so otherwise, don't take the risk. Do a 12-month STP and go in gradually on your equity. With your debt, it doesn't matter as much because the debt is not so volatile. You can make lump sum investments with your debt. So you are checking your asset allocation and checking, in my 70 debt, 30 equity portfolio, where am I deficient? And use the lump sum to balance that. If it's equity, do an STP. If it's debt, you can do lump sum purchases. Okay.
I think we've answered all the important questions for having an income after retirement or post-retirement are considered. But then let's slip into a short break, and post that we'll be connecting with our viewers over the phone line as well. And we'll help them plan all their financial goals and give them the strategies. WhatsApp number on your screen, the email ID also, if in case you want to send your questions. Welcome back. You're watching The Money Show, and it's time to take our viewer queries. And Srikant Bhagwat, our guest on the show, will be answering the questions live. Srikant, let's take Venkat's question. He says he's from Hyderabad, invested 4 lakh in Kotak multi-cap over a year ago, wants to add another 6 lakhs and plans to hold the investment for another 2 to 3 years. Wants to know the expected growth and whether to add more to the same funds. So he's got, Kotak multi-cap. What would you advise him? We don't have a lot of clarity in terms of the time horizon. 2 to 3 years, that's what he's planning to hold it. But it's going to be very risky because it's entirely equity. All right, Srikant.
Yeah. Since we don't have too much other information about him, but we know that he's got this one scheme going. Kotak Multicap has done fairly well. About the last 3-year return has been in the region of 18% CAGR. But it is not saying that that is what we'll be getting in the future, because we do know that we've had a wonderful mid-cap and small-cap run over the last 4-5 years, correct? So this is what has added to the kind of return. But the scheme itself has outperformed its index, and I would say it's a little more aggressive than its peer group, and that we can make out by the higher standard deviation or the higher downside capture than the others. Okay, so ideally one should have another scheme, maybe a second scheme, not just multi-cap fund, maybe go into a large cap fund or a flexi cap with a greater large cap bias. And that could be a complement to the multi-cap. Okay. So as you know, the multi-cap has 25% in each large, mid, and small, and another 25 is a discretion of the fund manager. So it does have more of mid and small, so it tends to be more aggressive. I would prefer to have a second scheme, which is more large cap in nature.
All right, let's take Rahul's question. Rahul Yadav, he's investing 8,000 per month with 5% annual step up. Investments are for the time horizon of 25 years, and his portfolio covers flexi cap, mid cap, small cap, and multi assets fund. He wants to know if the portfolio is suitable for long term wealth creation.
Yeah. If it is well balanced, okay. So the portfolio has, from what we saw, it has more of mid and small. Okay. So the SBI mid cap and the Axis small cap, half the SIP is going into mid and small. The multi asset is okay. And the flexi cap also is predominantly large cap, PPFAs. But overall, if you see, it has more of mid and small. Investors have been having more of mid and small in the recent times. It's a bias because we've seen the mid cap and small cap funds doing very well over the last few years. But this may not happen forever, correct? So it is good to balance it with large cap. So generally, we would be having at least 60 to 70% in large caps in a general portfolio. Okay, if somebody very keen on more risk can reduce large cap. So I think your SIPs or your larger portfolios can be more of a large cap oriented. Now, suppose you are having a lump sum that is coming into it, then you are not having the right balance in your accumulated SIP portfolio, then this is a time to rebalance with your lump sum, have a more of whatever is deficient. So in these cases, large cap is deficient. So top it up with more of large cap funds.
Let's move on. The other question is from Mr. Murthy, and he's 46 years old, investing in mutual funds since 2019, and retirement portfolio worth around 1 CR, heavy exposure to mid and small caps. He wants to invest 2.2 lakhs per month and wants a review on his portfolio and SIP allocations.
Yeah. So in his case, almost all of it is mid and small cap funds. It's too much. So it's a very, very aggressive portfolio, and we've been having a lucky time. So in this case, I very strongly advise that he balances it with substantial large cap. Okay. And if he's already in the retirement stage, I do not know his age. Okay. Then he should clearly have much of it large cap, because that is what is lower volatility. When you're in your withdrawal portfolio, you need to have lower volatility. Otherwise, you will not be able to sustain your portfolio over a longer time. Okay. And okay, in the accumulation phase, he can afford to have equity. In the retirement, he needs to have more debt, majority debt.
All right, I think with that, it's time on the show as well. We've tried to accommodate as many queries as we could, but thank you so much, Srikant, for, yeah, you want to say something?
Yeah, Kavita, if you have a few seconds.
Sure.
So there are two things one should be watchful about. So when you're in your retirement and your withdrawal mode, the markets are going to swing and your portfolio values will swing. Okay. Right. There may be times when the equity values have depleted because of the market. Okay. And one should also be flexible in your mind to draw less and spend less in such times.
Absolutely.
You should not be rigid that, oh, I do not want to miss my vacation this year.
Right.
Okay.
Yeah,
and
definitely.
withdraw more.
Yeah, definitely. I mean, better planning can really help on all those fronts as well. But we are time on the show. Thank you so much, Srikant, for taking your time out for our viewers today. Thanks.
My pleasure. Bye.
And for our viewers, I'm going to leave you with our WhatsApp number, email ID, just in case you are a viewer who is looking for any retirement planning or has a retirement portfolio. Once you get a review by our experts, send across your questions. The manish@18now.tv, the email ID. 865-797-4571 is the WhatsApp number. Thank you so much for watching. Goodbye.